ExamPrep.School. Vermont Producers Accident, Health and HMO Insurance Exam, exam code SERIES 14-27. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Disability income and related insurance, federal tax considerations, general insurance, group health insurance basics, health maintenance organizations, health policy general provisions, insurance regulation, medical plans, senior citizens and special needs insurance. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Which of the following is not required as part of an initial producer license application in Vermont? A. Payment of the application fee. B. Verification of passing a licensing examination. C. Proof of completion of approved pre-licensing education. D. A detailed business plan outlining future sales projections. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is D. The correct answer is a detailed business plan outlining future sales projections, which is not a component of the initial producer license application. Vermont requires the application fee, exam verification, and proof of pre-licensing education, but does not require a business plan. Reason A is not correct. Payment of the application fee is required as part of the licensing process. Reason B is not correct. Verification of passing a licensing examination is required to demonstrate competence. Reason C is not correct. Proof of completion of approved pre-licensing education is a mandated component. Question 2. David obtained his Vermont insurance producer license on October 3, 2022. Assuming he does not renew, on what date will his license expire under Vermont licensing regulations? A. October 3, 2024. B. September 30th, 2024. C. October 31st, 2024. D. October 2nd, 2024. The correct answer is C. The correct answer is October 31st, 2024, because Vermont producer licenses have a 2-year term and expire on the last day of the month in which they were issued. Reason A is not correct. This date applies a strict 2-year interval without considering that Vermont licenses expire at the end of the issuance month. Reason B is not correct. This date ends 1 month early and fails to account for the full 2-year term ending at the month's close. Reason D is not correct. This date is 1 day shy of a full 2-year period and ignores the rule that expiration falls on the last day of the month. Question 3. Under 8V ESSA Section 4724, which of the following best defines the prohibited practice known as rebating? A. Offering a reduced premium rate to certain insureds in the same actuarial class. B. Excluding specific benefits from coverage in exchange for additional fees. C. Permitting policy loans at below statutory interest rates. D. Providing a prospective policy holder with a portion of the producer's commission or any other unlisted inducement. The correct answer is D. This option correctly identifies rebating as offering commission or other unlisted inducements, which the statute prohibits. Reason A is not correct. Deferring premium discounts to selected insureds in the same risk class constitutes unfair discrimination but not rebating. Reason B is not correct. Excluding benefits in exchange for fees misrepresents coverage but does not involve giving a rebate. Reason C is not correct. Offering policy loans below the statutory minimum interest rate is an interest rate violation, not rebating. Question 4. Under Vermont regulations, which inducement would exceed nominal value and thus be prohibited when selling an insurance policy? A. A $50 portable charger gift offered to a client upon policy issuance. B. A $2 branded pen given at the time of policy delivery. C. A $5 coffee mug bearing the insurer's logo distributed at an industry event. D. A $20 policyholder jacket sold at actual cost. The correct answer is A. An inducement valued at $50 exceeds the nominal value limit, making it a prohibited inducement under Vermont law. Reason B is not correct. A low-cost promotional pen falls within nominal value exemptions, so it is allowed. Reason C is not correct. A modestly priced mug under the nominal threshold does not violate the rule. Reason D is not correct. Selling a jacket at actual cost does not constitute an additional inducement beyond nominal value. Question 5. Which of the following circumstances warrants the Vermont Insurance Commissioner issuing a cease and desist order against a licensed producer? A. A producer submits a license renewal application 10 days after the deadline. B. A producer repeatedly misrepresents policy terms in solicitation materials. C. A producer refuses to comply with a market conduct examination subpoena. D. A producer applies an unapproved rate to a single insurance policy. The correct answer is B. The correct answer is based on the Commissioner's authority to order producers to cease unfair trade practices, including repeated misrepresentations of policy terms. Situations such as late renewals, examination subpoenas, or isolated rate errors are addressed through other administrative actions. Reason A is not correct. Late renewal filings are subject to late fees or license expiration penalties, not cease and desist orders. Reason C is not correct. Refusal to comply with an examination subpoena leads to enforcement hearings or fines, rather than an immediate cease and desist order. Reason D is not correct. An isolated instance of an unapproved rate is resolved by corrective filings or penalties, not a cease and desist directive. Question 6. Which of the following statements correctly distinguishes pure risk from speculative risk? A. Pure risk involves only the possibility of loss or no loss, whereas speculative risk includes both potential gain and loss. B. Pure risk is voluntarily assumed by the insured, while speculative risk results from involuntary perils. C. Pure risk refers to systematic exposures affecting entire markets, whereas speculative risk involves diversifiable individual risks. D. Pure risk arises solely from intentional acts, while speculative risk originates exclusively from natural events. The correct answer is A. The correct answer is that pure risk allows only loss or no loss outcomes, while speculative risk entails both gain and loss possibilities. Reason B is not correct. Risk assumption by the insured does not define pure versus speculative risk. It relates to insurability and underwriting. Reason C is not correct. Systematic versus diversifiable risk refers to investment risk concepts, not the pure speculative distinction. Reason D is not correct. Pure risk is not limited to intentional acts. It includes accidental and natural loss exposures. Question 7. A construction site manager observes that overhead work has led to several near misses from falling objects. The crew already uses hard hats and safety nets. Which action exemplifies risk avoidance in accident prevention rather than reduction, transfer, or retention? A. Implement a strict hard hat policy requiring helmets in all work zones. B. Redesign job procedures so overhead work is carried out entirely at ground level. C. Obtain liability insurance to transfer potential accident costs to the insurer. D. Install safety nets below elevated work areas to catch falling objects. The correct answer is B. This option removes the hazard by eliminating overhead work, which is the essence of risk avoidance rather than merely reducing, transferring, or retaining it. Reason A is not correct. Requiring hard hats is a risk reduction measure because it mitigates harm rather than eliminating the hazard. Reason C is not correct. Purchasing insurance transfers financial risk, but does not prevent the hazard from occurring. Reason D is not correct. Installing safety nets is also risk reduction, since it controls the impact of falling objects rather than removing the hazard. Question 8. Which of the following components is exclusive to the capital structure of a stock insurance company and is not part of a mutual insurer's capital? A. Membership certificates representing ownership interests. B. Risk-sharing assessments levied on policyholders. C. Common stock issued to shareholders. D. Surplus accumulated from underwriting operations. The correct answer is C. A stock insurer is organized as a corporation and raises capital by issuing common stock to shareholders, which does not exist in a mutual insurer structure. Reason A is not correct. Membership certificates are issued by mutual insurers to policyholders and do not represent a stock insurer's equity. Reason B is not correct. Risk-sharing assessments are mechanisms used by reciprocal or mutual insurers, not by stock insurers. Reason D is not correct. Surplus from underwriting operations represents retained earnings rather than capital contributed by shareholders. Question 9. After posting unexpectedly strong surplus growth and favorable loss ratios, a mutual insurer declares policyholder dividends for the year. Under typical mutual insurer practices, which statement best describes the nature of these dividends? A. They are considered a refund of surplus and legally required under policy terms. B. They represent a return of excess premium and are payable at the insurer's discretion. C. They are taxable dividends paid from insurer earnings and treated as investment income. D. They are credited to the insurer's surplus and not distributable to policyholders. The correct answer is B. The correct answer is that mutual insurer dividends are a discretionary return of excess premium to policyholders rather than a guaranteed contractual benefit or taxable distribution. Reason A is not correct. Mutual insurer dividends are not a legally mandated reimbursement, but are paid only at the insurer's discretion. Reason C is not correct. These dividends are not paid from investment earnings as taxable income, but are a return of unearned premium. Reason D is not correct. Dividends are distributed back to policyholders and are not retained as part of the insurer's surplus. Question 10. At which point does the applicant in a typical health insurance unilateral contract furnish the consideration? A. At the time the application is signed. B. When the first premium is paid at policy inception. C. Upon submission of a covered claim. D. On each annual policy anniversary date. The correct answer is B. The correct answer is when the first premium is paid at policy inception, because in a unilateral insurance contract, the applicant's payment of the initial premium is the only consideration required to bind the insurer's promise. Reason A is not correct. Signing the application alone does not bind the insurer until the premium is paid and coverage begins. Reason C is not correct. Submitting a claim is exercising the policy privilege, not providing consideration to form the contract. Reason D is not correct. Renewal premiums at anniversaries are subsequent considerations, not the initial consideration that creates the contract. Question 11. Under the medical expense loss reimbursement principle, the insurer's obligation to indemnify the insured is best described as reimbursing which of the following? A. The lesser of actual charges incurred or the policy's scheduled benefit amount. B. The scheduled benefit amount regardless of actual charges. C. The full customary charge even if it exceeds the scheduled limit. D. A flat per diem rate without regard to actual cost. The correct answer is A. The correct answer is that the insurer reimburses the lesser of actual charges incurred or the policy's scheduled benefit amount because indemnity requires payment only up to the covered limit and prevents over-indemnification. Reason B is not correct. Scheduled benefits alone ignore actual incurred charges and would overpay if charges are lower than the schedule. Reason C is not correct. Reimbursing full customary charges above schedule violates the indemnity principle by allowing overpayment. Reason D is not correct. A flat per diem rate does not reflect actual expenses and is not part of the loss reimbursement principle. Question 12. Under an individual disability income policy, monthly income replacement benefits are typically calculated as which of the following? A. A fixed dollar amount per day multiplied by days disabled. B. A lump sum percentage of pre-disability earnings adjusted for inflation. C. Reimbursement of actual lost wages with no cap. D. A percentage of covered earnings subject to a stated maximum monthly benefit. The correct answer is D. The correct answer is that disability income benefits are calculated as a percentage of covered earnings, subject to a maximum monthly limit because policies cap indemnity to a preset proportion of income to manage risk. Reason A is not correct. A fixed per diem approach applies to hospital indemnity, not income replacement policies. Reason B is not correct. Lump sum payments and inflation adjustments are not standard methods for monthly disability benefits. Reason C is not correct. Policies impose a cap on benefit amounts. Uncapped reimbursement would exceed risk management limits. Question 13. A policyholder has an accidental death and dismemberment policy with a principal sum of $150,000. Under the policy, capital sum benefits are paid at 50% of the principal sum for each covered dismemberment event. After a covered accident, the insured loses his right leg above the knee and loses sight in one eye. How much will the insurer pay in capital sum benefits? A. $100,000. B. $75,000. C. $225,000. D. $150,000. The correct answer is D. The correct answer is $150,000 because the policy pays 50% of the $150,000 principal sum, $75,000 for each dismemberment event. One for the loss of the leg and one for loss of sight, totaling $150,000. Reason A is not correct. $100,000 is incorrect because it undercounts the combined benefit by not fully totaling both 50% event payments. Reason B is not correct. $75,000 is incorrect because it reflects only one of the two dismemberment events rather than both. Reason C is not correct. $225,000 is incorrect because it applies a 75% rate per event instead of the correct 50%. Question 14. Under a cancer-only policy, the benefit schedule typically defines A. Fixed dollar amounts payable for specified cancer-related services. B. Reimbursement of actual incurred expenses up to policy limits. C. A lifetime aggregate maximum benefit for any covered disease. D. Coordination of benefits following Medicare payment. The correct answer is A. The correct answer is that a cancer-only policy pays specified fixed dollar amounts for defined cancer-related services, as detailed in its benefit schedule. Reason B is not correct. Reimbursement for actual expenses describes expense-incurred coverage, not a predetermined benefit schedule. Reason C is not correct. A lifetime maximum limits total payout but does not specify per-service amounts. Reason D is not correct. Coordination after Medicare pertains to supplemental policies, not standalone cancer-only schedules. Question 15. A policyholder carries both a hospital indemnity policy and a major medical policy. The hospital indemnity plan promises a fixed daily cash benefit for each day of confinement, while the major medical plan reimburses actual charges after a deductible and coinsurance. In comparing these plans, which statement best describes how the hospital indemnity benefit differs from the major medical benefit? A. It applies a calendar year deductible before any benefits are paid. B. It pays a predetermined daily amount regardless of actual hospital costs. C. It reimburses actual billed charges up to a specified limit. D. It requires coinsurance sharing after satisfying a deductible. The correct answer is B. The hospital indemnity plan provides a set cash benefit per day of hospitalization that does not depend on actual expenses, whereas a major medical policy reimburses actual charges subject to deductible and coinsurance. Reason A is not correct. A hospital indemnity policy does not impose a calendar year deductible before paying its fixed daily benefit. Reason C is not correct. A hospital indemnity policy does not reimburse actual charges. It pays a scheduled amount. Reason D is not correct. A hospital indemnity policy does not involve coinsurance. It pays a flat daily benefit. Question 16. An insured purchases an accident-only policy that covers medical expenses resulting solely from accidental bodily injury and excludes any loss due to sickness or disease. Which of the following events would be excluded from coverage under this accident-only policy? A. A fractured wrist incurred while playing pickup basketball. B. A myocardial infarction occurring during exercise. C. An insect bite that triggers a severe allergic reaction. D. A knee ligament tear sustained during a fall off a ladder. The correct answer is B. An accident-only policy excludes losses due to disease, such as a heart attack, and covers only injuries from accidental external events. Reason A is not correct. Injury from a basketball fall is an accidental bodily injury and is covered. Reason C is not correct. An allergic reaction from an insect bite is a sudden accidental injury and is covered. Reason D is not correct. A ligament tear from an accidental fall off a ladder qualifies as a covered injury. Question 17. Under Vermont insurance regulations, what is the grace period for individual accident and health policies when premium payments are neither weekly nor monthly? A. 7 days. B. 10 days. C. 31 days. D. 45 days. The correct answer is C. Under Vermont law, individual accident and health policies must include a 31-day grace period for premium payments that are not on weekly or monthly schedules. Shorter grace periods apply to weekly, 7-day, and monthly 10-day payments. Reason A is not correct. A 7-day period applies only when premiums are paid weekly, not for other payment intervals. Reason B is not correct. A 10-day period applies only to monthly premiums, not to other payment schedules. Reason D is not correct. 45 days exceeds the maximum grace period authorized by Vermont regulations for any premium schedule. Question 18. Under Vermont regulations for group health plans, within how many days of termination must a certificate holder exercise the conversion privilege to an individual policy? A. 15 days. B. 60 days. C. 45 days. D. 31 days. The correct answer is D. Vermont regulations mandate that when group coverage ends, the certificate holder must exercise the conversion privilege within 31 days, following termination to secure an individual policy without evidence of insurability. Reason A is not correct. A 15-day period is shorter than the time frame specified by Vermont for exercising the conversion right. Reason B is not correct. A 60-day period is longer than the period allowed by Vermont law for conversion privilege. Reason C is not correct. 45 days exceeds the maximum window established for conversion under Vermont regulations. Question 19. Pearl Enterprises operates two offices, one with 12 employees and another with 10 employees. When a reduction in force leads to a qualifying termination, what is the employer's obligation under federal COBRA continuation coverage requirements? A. There's no requirement to offer continuation because each office has fewer than 20 employees. B. There is no obligation because each office is treated as a separate employer entity. C. Continuation must be offered because the combined employee count exceeds the 20-employee threshold. D. Continuation must be offered only if one office has at least 20 employees. The correct answer is C. Under federal COBRA rules, the employee count is aggregated across all locations of a single employer. And since the combined total exceeds 20 employees, continuation coverage must be offered. Reason A is not correct. Federal COBRA does not apply the threshold per office. It aggregates the total headcount across all locations. Reason B is not correct. Different offices of the same employer are not treated as separate entities for COBRA applicability. Reason D is not correct. Continuation requirements are based on cumulative employment, not on any single office meeting the threshold. Question 20. When underwriting a health insurance application, an insurer will most likely request an attending physician statement under which circumstance? A. The underwriter seeks more detailed treatment and prognosis information for a reported chronic medical condition. B. The underwriter requires verification of medical information obtained from the Medical Information Bureau. C. The insurer must independently verify the designated beneficiary's identity before policy issuance. D. The underwriter must confirm the applicant's age to determine eligibility under regulatory age thresholds. The correct answer is A. This option correctly describes that an attending physician statement is requested by an underwriter to obtain more detailed treatment and prognosis data about an applicant's reported chronic condition, which supplements information provided in the application. Reason B is not correct. An APS is not used to verify data held by MIB. It gathers first-hand medical information directly from the treating physician. Reason C is not correct. APS requests focus on medical details, not on verifying beneficiary identity, which is confirmed through legal documents. Reason D is not correct. Age verification relies on official identification records or birth certificates, not an attending physician statement. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.